Good to go. Okay, great. So again, starting off with some high-level thoughts. We'll talk about Fund One, of course. We'll talk about the development of the firm, and then, of course, where we're headed. So kicking off at the high level, our mission is to produce superior investment returns for you by targeting market inefficiencies that stem from geopolitically bifurcating tech ecosystems. You can almost kind of run that in reverse and say geopolitics is the geopolitical disruption, if you will, is creating inefficiencies that we're here to take advantage of those. Things have changed so quickly with US and China in particular. After decades of integration, the capital markets are left intertwined in really awkward ways. And our mission is essentially to untangle this knot, and that creates, again, special opportunities. So just one quick slide. Why, again, does this exist? Well, 20 years ago, even 10 years ago, the US and China were very complementary. US was much bigger than China. And we thought politically they were on a path to converge with what's sometimes called the liberal rules-based order. And that's not happened. Aside from the impact on the world, as investors, we think, hey, never waste a good crisis. So how do we take advantage? We think the opportunity for the next few years will be in secondaries. And we think it is a few years. It's not 10, it's not 1, it's somewhere in between. We think maybe 3 or 5. These secondaries are going to be coming in 2 flavors. So we've got an analogy here for you. Bear with me. Imagine each house in this housing development is a US startup that has Chinese investors on the cap table. We can buy positions a block at a time, buying a portfolio in a so-called GP-led secondary. That's what we did with Fund One. And we'll talk about a portfolio we're looking at buying for Fund Two. But we can also buy positions.
No, do you mind if I just have this?
Yeah, I'm sorry, was there a question?
Okay. I'm sorry about that.
No worries. Okay, so we can also buy positions one house or one startup at a time. Here we usually start talking out not to the start out talking not to the GP, but to the CEO, and that CEO often has a very acute problem they need us to solve. And you'll see us doing both years to come. So let's turn and say, hey, how has this worked so far? And let's look at Fund One. So I think the answer is so far so good. This graphic shows the CatchLight Fund One portfolio, where the area shows the value of each component company. We've got 10 companies. We're excluding Blockstack. It's a little bit small. So let's start in the middle. That's the fair value when we bought the portfolio in August of last year, 9 months ago. But we only paid the price on the left. So we're able to get a quick gain when we brought it back to that fair value in September. We like getting this discount, not only because it protects the downside, you've got to really squeeze this value to eat into your principal, but also because it acts as a multiplier on the upside. So, that 3x return you might have gotten, ends up being a 5x. But we think like investors, not bankers. So our primary focus is on the quality of the companies underpinning this purchase. And we're pleased to say the quality of the portfolio is what's now kicking in and driving the returns. That's what's driving this last quarter's tick from 1.7 to 2.6x on the original portfolio. If you look at the key on the right, you see the fair value in 4 companies increased in Q4 and Q1, our first 2 full quarters holding this portfolio. The Dandelion and Memverge rounds really validated our expectations that they would be value drivers of the portfolio. But we're also happy that the longer tail in the portfolio has kicked in, via Trust Token in particular, which was the 7th most valuable position, and is now moved up to the 3rd most valuable. You can see that we bought it at this price, and now it's occupying this area. And these are in ratio to their valuation change. So let me walk through now some of the portfolio performance stats. We've called 2/3 of our $15 million fund, so $10 million exactly. We've generated if you look at the bottom, total value net against that of 2.1x. Obviously a healthy IRR. That's going to decline, of course, as time passes, but it's a great way to start. The new news here, even from the letter we circulated a couple days ago, because we were putting the finishing touches on it, was we have realized now 2.4 million in value from the sale of 3/8 of our trust token position. We plan to distribute that this quarter. If there is also a near-term capital call, we'll net those out just to ease your administration. So we're pleased, but we're not complacent. Even though we're typically smaller players on the cap table, we're not passive. We are in touch with management on average every month with all these companies, especially weighted towards those who are either facing key decisions or are larger positions for us. So I will mention that none of the companies in our portfolio, interestingly, are raising right now. So the next quarter or two should be relatively quiet in terms of marks. But I would say we feel good that value is continuing to accrete in this portfolio, even if it doesn't show up in the numbers immediately. And in fact, it will ultimately be reflected in the numbers. So, a bit of caveat, this is, of course, venture capital. We will lose money on some of these companies. We may even have down quarters at the portfolio level, but we really do like where we sit on the portfolio overall. We do expect the multiple that we've seen so far to extend. And so a great start. Let me shift gears to decision-making, not for that upfront portfolio, but for decisions going forward. So highest level, our goal is to take prudent risks for you to return a multiple of your invested capital with high confidence. And you've seen our decision-making in process, last year in buying this portfolio. That in turn drove your own decision-making in joining us. And you see how that's been working. So let me take a moment now to share our decision-making on subsequent investments of a few different flavors. So within the existing portfolio, we can invest in new primary rounds. And in some cases, we can't always control it, but in some cases, secondaries as well. However, our funding capacity is limited. So on primary rounds, we do take a life cycle VC mindset, but we have a particularly high bar for follow-ons. So in part because of our reserves are about 1/3 of the fund, and that compares to a typical fund's 1/2 to 2/3. So 3 of our companies have, as we talked about, have done rounds since we acquired the portfolio. That's Dandelion, Memverge, and Boom. As you know, we leaned into one of those 3 last quarter, Dandelion, where we had particularly high conviction. That conviction, we've crossed the Rubicon here into the invest zone, stems from factors like round characteristics, confidence in the team, size of the opportunity, and so on. We use our investor letters to give you a more detailed window into our thinking, so I won't belabor it here. Boom was on the smaller side, so I'll skip over that. Memverge, you may recall our write-up from last quarter. We like the company, we really do. We like the company, the team is killer, the market's huge, their product is outstanding. But the latest round had a higher valuation relative to traction. And we think there may be secondary opportunities down the road, 29% of the company being held by Chinese investors in a fairly sensitive technology. So we stood by on both of those companies. Trust token was our 4th decision in our first couple of quarters. We had the option to hold our position, add to our position, or sell part of our position. The 3/8 that became unlocked actually as recently as a few days ago. We decided to sell. That's not necessarily a commentary that they are a bad company. We think they're actually in the leadership position in a market that could be quite interesting. And we were holders at the Q4 market price. But their token valuation roughly tripled in Q1. And we've got 5/8 of our positions still locked. So we thought the better move was to take liquidity. And as I mentioned just a moment ago, we have now, just as of yesterday, taken 2.4 million of liquidity from Trust Token. So one other type of transaction we can make are secondary new logo opportunities, new companies with LPAC approval. The bar is the highest here, but these opportunities can also be particularly attractive with higher than average discounts. And of course, any new name brings additional diversification. So we're likely to add a name or two to the fund before we close it out. So lastly, let me turn to the firm, where our goal has been to continuously strengthen our capabilities. At the team level, most importantly, we've had the pleasure of working with a number of young venture professionals, but one of them has really stood out. That's Josh Lee. I mentioned him earlier. We brought him on full time a few months ago as senior associate. Josh has several years of experience in early stage venture and has already had an impact. We're very lucky to have him. So that's new on the team side. What's not new is the service providers. That's actually the good news in this case. We've got Standish and Fund Administration, who has been fantastic. We're also very well supported by Wilson Cincini and Frank Rimmerman on the legal and tax and accounting sides. So we launched with what we thought was a great extended team. They've exceeded expectations. We're excited to continue to work with them as we grow the firm. We've also been investing in our internal processes and systems, CRM system, things like that. What you haven't seen much of, if you've been poking around, is marketing. And that's intentional. We do expect to ramp that up over time. But for now, our strategy really requires more in the way of relationship sales, talking to those GPs, talking to the CEOs, than marketing. We have a pretty good sense of certainly where the portfolios are going to come from. We've even stack ranked them in some respects. We'll get into that in a moment. So we're not in stealth mode. You can tell your friends, but we're not advertising our strategy indiscriminately for the moment. Lastly, fundraising. We're starting to have conversations with new folks now to give us more capacity for our next fund, which Wei is going to talk about. Many of you have made intros to investor friends for us, and for that, we are grateful. Please keep them coming. Pipeline, turning to the future. We have a robust pipeline of both portfolio and individual secondary opportunities. So let me turn it over to Wei now to talk about that and where we're going.
Thank you, Greg. So if we go to the next page, yes. So with the foundation we've built over the last 9 months, we feel good about further advancing our strategy. So we always looking for motivated sellers, in this case, the Chinese investors. And we understand their challenges to sell their US assets to the secondary buyers in the US. On the buyer side, we still haven't heard any competitive footsteps behind us. These are some of the reasons why we haven't. Doing what we do does take some hurdles. And for example, the GPs must be US citizens. Most of the LPs must be US as well. These are required by law. And it also takes somebody in the sector to understand the opportunity. And also some skills would come in handy. For example, you'll be able to evaluate and then manage some of the early mid-stage companies for a period of time. And Mandarin would come in handy when you try to approach some second tier, third tier VCs in China. And existing relationships is still valuable. And plus, we take a fairly different approach when we do secondary than the traditional secondary funds. We typically focus on portfolio instead of individual companies. and we write smaller checks. So these are the reasons, frankly, that we were successful in raising the first fund. And overall, we feel that we are in a unique position to keep acquiring high quality assets at an attractive discount. So next page, we have observed a spectrum of behavior from the Chinese investors, our potential sellers. And it's really a function of two things. Number one is the type of investors they are. Are they typical VCs investing in the US? Are they the corporate funds, right? Tencent or Alibaba, or even the corporate funds that are currently on US blacklist, take Huawei, for example. Or are they state-owned funds, ZGC, a few others, for example. And also the second factor is, what are the reasons that they came to the US, right? Are they looking for financial returns? Or are they looking for talent to build companies either in China or in the US? Or are they looking for the cutting edge technologies? In some cases, we understand the behavior if we understand the two factors, right? Take, for example, if I am looking for the cutting edge technologies, I'm not overly concerned about financial returns. I would probably stay till the very end, even if that means I probably lose some financial returns along the way, right? That'd be okay. It's not my primary concern. So this would translate to us different pace and different time by the time they're ready to sell their assets, and which is a good news for us. We were looking for the Goldilocks timing. That means sellers become ready when we are. So next page. We are in a pretty target-rich environment. If we look at our pipeline, we've talked to 12 funds, Chinese investor funds, and in combination, they have invested in 300 plus US tech startups. In total, with $800 million or so in these companies. And when we look at the companies and the portfolios we have evaluated, we think the bottom 4 boxes are likely to come into Fund 2. I will highlight one of those 4, the portfolio we label as Portfolio SI, right, in the blue, deep blue. This portfolio belongs to a Chinese venture capital firm. It's really well known in China. It's also well known in the US in some circles. And we have signed exclusive term sheet with them. So we have a few months window to look at the 20 plus assets in the portfolio. All of them are in the US. And then we have this window to make a purchase. So if we take a sneak preview of these 20 plus assets, these are the assets under pseudo names. And this is a Pareto chart of all the assets. And not surprisingly, you have 3 top runners likely to become the value drivers for the portfolio. And also not surprisingly, you had a handful of low performers. They are barely worth anything, if at all. And then you have a bunch in the middle. So we don't rule out the possibility that 1 or 2 may break out. Just like what we experienced in our first fund, right? Trust Token and Boom, for example. So that's the portfolio we're looking at. It is likely to become the anchor portfolio for our CatchLight Fund 2. And so next page is the fund likely process. So again, this anchor portfolio is under exclusivity, and the target fund size for Fund 2 is 40 million. But looking at the anchor fund, anchor portfolio, and then the other possible candidates for Fund 2, this may go up a little bit. And the expected close date is mid to late summer this year, so a few months away. And a data room will open in June, second half of June. Terms will be very similar to Fund 1. And in the next few weeks, we'll start the soft circle. And Greg and I have talked to a broader range of prospect investors into Fund 2. And we're grateful again for some of your introductions. And however, we would always make our current LPs first. And in the next few weeks, Greg and I will reach out to you and learn about your appetite for Fund 2 so that we can reserve the appropriate allocation for you guys. So with that, we conclude our LP update.